Hi. Hello, and welcome to the November 2022 issue of the Zavitz Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner, Mark Zavitz. Today, we're going to keep things short and simple and give you a market update over the next 10 minutes, covering what happened over the past month. And this month, we're going to try to make things a little less boring for you based off some of the feedback we got. So, let's talk real quick about performance in the portfolios. Here's a year-to-date view as well as a one-year view. Just to recap real quickly, equity markets, stock markets, they're down 10 to 30% depending on the market you're looking at. Bond markets are still down 10 to 20% this year. Our models, which consist of a combination of stocks and bonds and the various mutual funds and ETFs that we own, on a year-to-date basis, the growth portfolio is down around 15%. The moderate portfolio is down around 12%. Same thing with the conservative portfolio, and the very conservative portfolio is down around 10%. So I wanted to talk real quickly about one of the largest positions in everybody's portfolio, and that is the ETF component. So roughly 70% of our clients, likely you, are in either the very conservative or conservative model portfolio. And about 20% of our clients are in the moderate portfolio. In each of these model portfolios, there's that ETF component. And this usually makes up about, if you look at all of your accounts, about 40 to 50% of the portfolio. The reason why I like this position and why it's in your portfolio for myself, for my family, why Mark has it in his portfolio, it's because it's an ETF that actually has 8 ETFs inside of it. So, to give you a bit of background, I was a portfolio manager working downtown for a former Minister of Finance, Garth Turner, and I ran about 200 to 250 million of his assets. We were using almost exclusively ETFs for our clients, but instead of going out and buying one simple ETF like I do for you, we were going out and actually manually buying a portfolio that's similar to these ETFs, but we were buying all of the positions individually, or that's what I had to do. So you'll notice, if you look on this slide, that there's 8 ETFs inside. There's 4 equity ETFs in blue writing, and there's 4 fixed income ETFs, which is the orange writing. And so, you might have heard that markets recovered in the past month, but the fixed income component of our ETFs, which make up, at least for our conservative and very conservative clients, 60% of the portfolio, that really hasn't done too much lately. But the good news is that we think the fixed income component of your portfolio is going to start experiencing some very solid returns. So yes, equity markets had a nice rebound in the month of October, actually one of the best Octobers we've seen in history in the past 50 years. But if I go to the next slide, this is what we think is going to start happening for the fixed income, the orange writing, that portion of your portfolio, especially if you're a very conservative or conservative model portfolio client. So, Mark's talked about this. Rates have been very low for a very long time. And the bond portion of the portfolio found inside of the mutual funds or that ETF position was going to have return characteristics similar to the dark blue line on the screen. And in our meetings with you, as you've heard Mark and I say it many times, as rates go up, bond prices go down. So think about it. Let's say you're a portfolio manager and you're in 2021, which is last year, back when rates were extremely low, and you're going to go buy a Bell Canada bond. Well, that Bell Canada bond that you'd be buying as a position inside your mutual fund or ETF was only going to get you 1%. So when rates go up because of inflation, what happens is Bell now issues that exact same type of bond with the exact same level of risk for 2%. And then as rates continue to go up in 2022, Bell now issued that bond for 3% and then 4%, etc. So that's why the existing value of that bond in your portfolio at 1% goes down. Now, the good news is that this is usually temporary, as you can see on the slide. Because bonds now yield something, even though they've lost value in your portfolio as the new higher yielding bonds replace the old bonds, they will quickly make up that loss. And over the next few years, even without rates coming back down, eventually will result in a better return, as you can see in the light blue line. So it takes, 4 to 5 years. So if you're a very conservative or conservative client and 50 to 60% of your portfolio is in bonds, it's temporarily sucked. But as long as you stay invested and you keep your allocation in these holdings over the next 4 to 5 years, you're actually going to start coming out ahead as previously as you were in the past. Mark, is there anything you want to add? You always have a good perspective when it comes to talking about this.
Thanks, Greg. You actually did a very good job. So I'm not going to say as much as I thought I was going to, but I'll reiterate, some of the points you made. If we look back, Greg, 12 months ago, we were looking at our portfolios for all of our clients, and most of them had 30 to 60% of the portfolio in fixed income. And it was, the returns, when we were sitting down with clients and they were asking us, what's a reasonable expected return for the portfolio? And when we had those discussions, we were being as fair as we could be and as objective as we could be. And we were talking to clients about making nothing over the next several years on their fixed income investments. Maybe 1%, maybe 0, maybe -1. So that was pretty depressing. Well, the bad news in the last year is that fixed income, as you mentioned, $100,000 of fixed income has dropped to 90 or 85,000. However, I just want to stress the point you made. The good news is that the yield going forward for that component of the portfolio is now 3 or 4 or 5%. And that's if interest rates don't come back down, if they level out. I'm looking forward, well, I'm not looking forward to a recession, but I'm thinking that, there's going to be a significant slowdown economically. And there's a very good probability that the central banks around the world will want to stimulate the economies at some point in 2 or 3 years, and that means they're going to hopefully be able to drop interest rates. And so what that does is that actually makes the crossover point, happen quicker. And so, so we're going to start getting yield on our fixed income, which we weren't going to get for, a year or 18 months ago. And, I'm hoping in a year or two, we're also going to start to get some capital gains on top of the much higher interest rates on the fixed income. So everyone's just got to hang tight. And, a lot of the damage has been done, and we're going to start to get some returns going forward on the bonds.
Yeah. No, thanks, Mark. That's great. It's exactly in line with, what I think is going to be happening over the next year to 2 years. So let's pivot. Let's talk inflation real quick. So we've been hearing about inflation, obviously, if you tune to the news or if you read anything when it comes to the economy, most of the headlines are about inflation. Our perspective on inflation is that it is sticky, but it's been sticky because of the fact that we as Canadians, and if we lump ourselves in or group ourselves with Americans, we as North Americans have just so much extra cash on the sidelines. And really what's been happening over the past 6 months is, yes, we've been feeling the effects of inflation, and it has really started to affect demand. But what has been able to keep sort of demand persistent is the fact that we've got all this extra savings that's absorbing all of these price increases. And my perspective is that I think over the next, 2 to 3 or 4 or 5, 6 months, we're going to have eaten up all of our extra savings. It looks like, rates are going to stay high for the next 6 months to 7, 8, 9 months. So they're going to remain at this level until at least summer or fall of 2023. And that's because from what I've been reading, of this 4.2 trillion that we've been able to save, we've eaten up about half of it. So we still got another $2 trillion, give or take, in we'll say North America, of buffer that's going to be there to be able to spend. But once, and this is where the recession is going to come in, once we've used up all that extra pandemic money, I think rates are going to start to fall from the 4 to 5 levels that they're at today, and they're going to eventually start coming down, and that's going to happen in fall, winter, sometime around that time next year. So, I don't know exactly. I mean, the goalposts keep moving. I don't know exactly when this is going to happen. The markets are forecasting that this recession is likely going to start hitting summer of next year. Now, it was originally going to be spring. So I don't know exactly, again, when we're going to see this fall off happen, but it will happen next year. It was originally going to happen early next year. It's likely going to now happen middle to end of next year. But when it comes to equity markets already have this priced in. That's why they're already down, despite consumers using this extra cash. That's why they're already down 15, 20, 25, 30%. So, let me go back one. This is just a breakdown, if you look on this slide, of who has the cash. It is the middle class, it is the upper middle class, it's the rich people who have been hoarding cash over the past 2 to 3 years and have been spending it over the past 6 to 12 months to really keep driving the economy. So when you hear pent-up demand, it's mostly on the backs of savings that have happened over the past 2 to 3 years. And despite inflation being here and everything essentially being 10 to 20% more expensive, that's why things haven't slowed down so far. So everything that I've been talking about actually has a name. It's known as the wealth effect. And the wealth effect is essentially when your assets, your savings, your home, your possessions, your investment portfolio, your antique stamp collection, your Bitcoin, your hockey cards, your Pokemon cards, whatever it is you collect, all significantly increases in value. And what it does is it gives you this sense of security and confidence that you can now go out and spend a little bit more than you were spending in the past. And it's not just you who feels that, it's everyone who feels that. So in turn, everyone starts spending a little bit more and the economy starts chugging along even faster. Well, we are in this positive wealth effect. It's almost like a tough to stop train well into 2022. And right now, actually, we're in the middle of this wealth effect starting to reverse. So now we're actually starting to have a negative wealth effect. The best way to understand the negative wealth effect is if you see consumer confidence start to come off. One of the biggest drivers of wealth effect, as I listed off a few, is housing. So actually, it's the biggest contributor. So the biggest contributor to the wealth effect being real estate. If you look on this slide and you look at the dates starting in 2022, you can see we peaked in February based off the orange line from a price standpoint. But since then, everything is down. We've got stocks and bonds, as I've already said, that are down 10 to 30%. But now real estate is down 10 to 20%. And we're really just being buoyed by the savings, this extra savings. But eventually, and this is what the market's already baked into the price, as that pandemic savings gets drawn down, we're going to start to see lower demand, unemployment's going to start to come up. And when that actually starts to happen, that's when the stock market and bond market is really going to start to rally, or at least that's my prediction. In October, the markets were already starting to forecast that a little bit, anticipating that was already start to happen. That's why we had such a good rally in the stock market. The bonds weren't quite seeing it. They weren't seeing eye to eye. Mark, looking into your crystal ball, we've moved the goalposts a couple of times, or we've had to because inflation's remained sticky and this pandemic savings has lasted a little bit longer than we expected. So we were anticipating a recession to come end of this year, beginning of next year, when we did one of our first monthly updates in the summer. Now it's looking like the recession will hit sometime in the spring or summer of next year. How do you think this is all going to unfold? Like, what do you think is going to happen to the stock and bond market?
Well, we're going to continue to have a significant amount of volatility for the next, I would say, 1 or 2 quarters. That volatility is predicated on information flows. It's really a seesaw battle right now as far as the financial markets are concerned. It's changing unfortunately weekly. This week the market thinks inflation has peaked or is almost peaked. Well, they know that top line inflation has peaked, but they're looking at core inflation and they're hoping that it has peaked and it for a week or two everyone's comfortable with that, and therefore interest rates don't have to go up very much more, and then the financial assets start to respond positively. Stock market goes up. 2 weeks later, the opposite happens, and we get some financial information that says, as you mentioned, that inflation is a little stickier and it's going to be around a little longer, and unemployment is being, you hate to say that the system needs more unemployment, but it does. Labor market is too tight, and so on one hand we get data out about unemployment this week in Canada and the United States, and it was good. It was good economic data, like 238,000 jobs in the States and 108,000 in Canada. So on one hand, you think, wow, that's really good. We're still chugging along, which is why you mentioned, the slowdown or the mild recession is probably not going to happen in a month or two, but probably in 3 or 4 months. Because the economy is being very resilient. This pent up cash is continuing to keep things chugging along, but it's going to come to an end. The cash, you can see it, unfortunately, with the with the clients and with our family members that have modest incomes and lots of debt for on their houses that they bought in the last couple of years. You can already start to see that people are getting very tight. Credit lines are going up. Visa balances are going up, and so it's really just a matter of months, I believe, and we're going to start to see some significant slowdown economically, and I would expect that stocks and bonds will rally at that point or shortly thereafter.
It's crazy. As the economy gets worse, the markets are going to rally. I'm just going to end things real quickly here and just say I was fortunate enough to go to a portfolio manager conference day to hear from some of the managers that are part of the positions in your portfolio. For some of you that own the floating rate fund, as well as what other fund in there? Dan Belstasic, but we don't have many clients who own him anymore. But regardless, every single portfolio manager that I talked to, if they were a stock portfolio manager, if they were a bond portfolio manager, they were extremely bullish about next year, forecasting double-digit returns for almost every single asset class. So, I mean, take it with a grain of salt, I guess, because people are really bad at predicting the future. However, I think they're very cautious, at least most portfolio managers are, at making these types of predictions, especially when it's so bullish, because if you're wrong, you look really bad. But I've never heard 3 different managers who do different things all come out and say next year is going to be a really good year. And I firmly believe that. I think Mark also firmly believes that as well. So we think our clients are going to benefit next year, especially. So thanks for tuning in. Really appreciate anyone who stayed on this long. And if you have any questions, feel free to reach out to Mark and I. We're always happy to have a meeting with you and to help you. Okay, thanks so much.
Thanks very much, everyone.